We're going to talk about book module 6, and this is on inventories, payables, and long-term assets. So um, let's start off with inventories. Now, the first thing we need to know about inventories is the way we account for inventories is strictly an accounting thing, right? It has nothing to do with how we actually with one exception, it has nothing to do with how we actually take care of what comes in and what goes out on a cost of goods sold basis. So the idea being, if I were to say be in the business of selling writing utensils like this, and I start with one, right? And then I add one like this, and then I add another one. I'm using different colors so you can keep track of them, like this. And then I get rid of one. If I'm on FIFO, which stands for first in, first out, I take this first one away. And then I add another one. And then if I sell two more, I take those away. And then I add another one. It becomes like this, right? And so I keep sliding. So this being the front, this being the back, they come in, they get taken from the front, get inserted in the back. On the other hand, if I am on FIFO and I have one to start with, and I add a second one, and now I sell one, I take it from the back. And now I add two more, like so, and now I sell another one, I take it from the back. So this first one always remains. So that's FIFO, first in, or LIFO, first in, last in, first out. So these are just different accounting conventions, but it has nothing to do with how we actually do that. The two other inventory conventions that we have are weighted average. So I just throw all the numbers in there and I take an average of what it is, and I'm good with it. The fourth one is called specific identification. Now, specific identification is used for high value things that have different values. So expensive jewelry, really high dollar jewelry, or automobiles, farm equipment. So those are all those all have serial number. Well, jewelry doesn't, but those all have serial numbers, and they have slightly different prices. You can buy an automobile, and you can buy the plain or the deluxe. You can get different engine sizes. You can get different seating packages. Is it leather? Is it cloth? Et cetera, et cetera. Does it have? Does it come with heated seats, heated and cooled seats for the driver and front seat passenger, or not? These are all different variations of the same basic frame of automobile, and so you can have these different things going on with them. So it's important to know. So we're going to start off with FIFO, first in, first out, and then LIFO, last in, first out, weighted average, and specific identification. All right. So let's start off. Now, on top of that, there are two other things. There are two ways to keep track. This is just the accounting convention, but then there's two ways to keep track of inventory. There's perpetual and periodic. So perpetual means that every time I add to my inventory, the inventory accounts are updated, and when I sell something off, the inventory accounts are updated. The contrary to that is periodic. Now, technology, for specifically barcoding and radio frequency identification (RFID), has made it much easier to do perpetual inventory systems. So, like if you go to Walmart and you buy, um, if you buy a bunch of canned goods and maybe uh, uh, some other stuff, a T-shirt, something like that, they run it through a scanner, barcode scanner, and that inventory is updated every day. Now, that doesn't mean we get away with not ever taking a physical inventory where we go in and count, because what they call slippage. Slippage is where things walk out the door without being paid for. Um, that those still occur, right? And so we still have to take a physical count to make sure. But in general, they have a pretty good idea, and if they know what their slippage rates are, they have a really good idea what their inventory is at various times. And that slippage is why we see them, stick more expensive things behind counters and lock it up, and have those, stores like Dillard's and whatnot have those magnetic things. If you buy a set of clothes, they have to take off that electronic tag, all that kind of stuff. So with perpetual, I have a running total. With periodic, I only keep track of my purchases, and then at the end, then take a physical inventory and I add up all my purchases, subtract my physical inventory, and that gives me cost of goods sold. Okay. All right. So let's run through an example of that. I'm going to use 5 items. And these items, to demonstrate FIFO, LIFO, and weighted average, we're going to assume that these are all the same type of item, right? So the customer really doesn't care if they get number 4 or number 1, right? This would be like me going to Home Depot and picking up a bag of screws, 10 screws in a thing. If they're number 8 1-inch screws, I don't care if Home Depot got them last week or if they got them last year. If they've been sitting on the shelf for 8 months, it doesn't matter to me. They're not going to go bad, right? So we're just going to assume that these are all the same good, and they're going to be purchased for different prices. So let's say this one is $10, this one is $12, this one is $13, this is $14, and $16. Now you'll notice that the price is steadily increasing. I did that on purpose. We'll do an example here in a minute where the price is decreasing to show you how. Now, here, in between here, I'm going to sell 1 unit, and here I'm going to sell 1 unit. Okay, so let's go through and show what happens with FIFO. So with FIFO, I've got FIFO is first in, first out, right? So I've got a 10, and then I buy a 12. So this is the oldest to newest, right? And so I've got a 10, I've got a 12, but then I sell 1 unit. This is FIFO, so it's first in, first out. So that one is gone from an accounting standpoint. Doesn't really matter which one of these I sell, but from an accounting standpoint, that 10 is gone. Then I buy another one and I get 13 here. And I buy another one and I get a 14 here. And then I sell one, FIFO. So the 12 is gone. So this is, by the way, with FIFO, it doesn't matter whether you do perpetual or periodic, you're going to get the same answer. LIFO, that's not true. And then finally, I'm going to buy one for 16. So now my cost of goods sold is going to equal the 12 plus the 10, these two right here. And my ending inventory, that's 22. My ending inventory is going to be 16 plus 14 plus 13. And that's going to be 43. All right, so that was FIFO, and it works out the same whether perpetual or periodic. Now let's do LIFO, and it's going to be perpetual. Okay. So now with LIFO perpetual, I've got the same 10, that's there, and then I add a 12. Okay, so now I've got 2 in inventory, and now I sell 1 unit, but this time I sell that unit, right? And then I buy another one for 13, and I buy another one for 14, and then I sell 1 unit. So I'm going to sell that unit, the last one that came in. And then finally, I buy 1 more unit. So I still have 3 in inventory. And my cost of goods sold is going to be the 2 I sold equals 14 plus 12 equals 26. And my ending inventory is going to equal 16 plus 13 plus 10. And that's going to be 39. Okay, so now one of the first things you want to notice is that the cost of goods sold in the ending inventory is going to end up, the sum is going to end up the same regardless of which method I use. So 22 and 43 is 65, 26 and 39 is 65. But my cost of goods sold is 26. Now, what does that do for you? Okay, so a couple of points here that are important. Are that LIFO, in a period of rising prices like we have, LIFO is going to give you a higher cost of goods sold and a lower ending inventory. Now, this gets back, if you remember the first lecture I talked about under GAAP, General Accepted Accounting Principle, the U.S. way of doing things, that we generally do if given a choice between the income statement and the balance sheet, we make the income statement more, we make that the correct one. Okay. And so you can say that since prices are going up, this balance sheet is out of date. This inventory item, which is on my balance sheet, is a little bit out of date, right? $43 versus $39. That's one thing. Now, but what it does is if you use LIFO, it has no effect on your cash flow with one exception, and that is taxes. Because if I sold this, let's say in both cases, I sold 2 items, I sold them for $25 a piece. Here I have 50 minus 22 is $28. I pay tax on $28. 50 minus 26 is going to be $24, and I pay tax on $24. And so LIFO will if you're in a period of rising prices, LIFO will give you a lower income tax charge. All right, so that creates some other interesting things. In the US, we are allowed to use LIFO, but if we use LIFO for our income tax statement, which gives us a lower charge in most cases, because most of the time prices are rising, not always, but most of the time. If we use it for income tax purposes, we are required by law to use LIFO for our financial accounting. Now, I don't know if you're aware of this or not, but in the US, we are allowed to keep two sets of books legally. That's nothing illegal about that. We can keep a set of tax records and we can keep a set of financial records. And that's why from time to time you'll see this. We have corporations that made billions of dollars and paid zero tax. Well, there's a number of reasons for that, but one of them is because we can do different things with our sets of books. We can account for things differently, but not LIFO. If we choose LIFO for tax, we are required to choose LIFO for our corporate financial accounting books. Okay, that's great. In Europe, well, mostly Europe, but anybody who uses the IFRS, the International Financial Reporting Standards, they are not allowed to use LIFO. They can go up here and they can use FIFO, they can use weighted average, they can use specific identification, but they are not allowed to use LIFO and on International Financial Accounting Standard. Now, everything has a trade-off. The advantage is, if prices are rising, the advantage is the income statement will be more accurate. Well, what do I mean by more accurate? It means that if I'm looking forward, my costs to replace those two I sold are better represented with LIFO than they are with FIFO. With LIFO here than they are with FIFO. And so my income statement is more accurate using LIFO, but my balance sheet is out of whack if I use LIFO. And on the other hand, if I'm under IFRS and I have to use FIFO, my balance sheet is more correct, but my income statement's kind of saying I have inflated my real revenues or my real income. I don't think that's a mistake. I think that many of the countries that use IFRS prefer to tax their businesses a little heavier. But that's just my opinion. I haven't seen any documentation on that or any research that indicates that position is true. All right, so let's see what happens with weighted average. And so weighted average, what happens is I have this 10, and then I have this 12, and now I sell one. And so I blend these two together, and I'm left with an 11. Okay, so I sold one there. Now I add a 13, and then I add a 14, and I blend all three of these together. So now I've got 27, 38, divide by 3. And I get 1266. And so this goes away, this goes away, and this goes away. And I'm left with 1266, 67 really, if I round up, and 1267. Now I buy that fifth one for 16 in here, and now I have to finish this up. So my cost of goods sold is going to be the 11 the average between the two that were in inventory here, and then the 1267 is 2367, and then my ending inventory is going to be 1267 plus 1267 plus 16 is going to be 4134. Now, so I got a little bit of rounding error here, but once again, this adds up to 65, right? Just like we said. And you'll notice that my cost of goods sold is between FIFO and LIFO. My ending inventory is between FIFO and LIFO. And that's what you get with weighted average on that. So that's kind of how those work. Now that is perpetual. Let's take a look at periodic. Now, remember, in periodic, I only keep track of the purchases, and then I make a physical count and do it that way. And so my sales are, this is just the same information we had before. Number one was $10. Number two was $12. Number three was $13. Number four was $14. And number five was $16. All right. And so now I'm going to do I'm going to do the LIFO, last in, first out, but it's perpetual. So the way I do that is I add this all up. It's 30, 43, 55, 65. So my total purchases were 65 units. And then last in, first out. So I've got my goods available for sale is 65 minus cost of goods sold, 10 and 12, got rid of those, and that is 22. And so I ended up with 43 as my ending inventory. Now, as I said, first out. So if my ending inventory is 43, my cost of goods sold equals 22. And like I said, when we do FIFO, it doesn't matter whether we do perpetual or periodic, we will always end up with the same numbers. So these numbers are the same here, right? Okay, well, let's take a look at LIFO now. My goods available for sale are the same, is 65, but now LIFO, I sold these last two, so minus 30, and that's going to equal 25. And 35, I can't do math in my head. Okay, so that's going to equal 35 as my ending inventory. So third cost of goods sold equals 30. Now come over here. Here's my FIFO. My ending inventory was 39. Now it's only 35, right? So the perpetual and the periodic gives me a different number under LIFO most of the time. You can construct a scenario it won't, but most of the time it will end up with different numbers for ending inventory and cost of goods sold. Finally, on the weighted average, I take the goods available for sale equals 65. I then divide that by 5, the number of units, and that will end up being 13 is my average. So my cost of goods sold is 2 times 13 is 26. And my ending inventory is 3 times 13 equals 39. And once again, my ending inventory is between this 35 and 43. It won't always be halfway like this one is, but that, and then the cost of goods sold will be also partway between, so 30 and 22 on the cost of goods sold. So that's the weighted average. Okay, so that's kind of what's going on there with the inventory. Let me do specific identification, same one. So I've got the same scenario. I've got number 1 cost me $10. Number 2 cost me $12. Number 3 cost me $13. Number 4 cost me $14. And number 5 cost me $16. Now remember, I sold a unit here and I sold a unit here. And so I come in and the guy says, the guy comes in here this first sale and says, I want to buy one. I go, which one do you want? Number 1, number 2. And he says, I'll take the cheap one, number 1. Okay, so my cost of goods sold is 10. That's gone. Then I come in here, somebody comes in here and says, I want to buy one. And they say, and I say, which one do you want? The 12, the 13, or the 14? And he goes, oh, I like the color of the 14 better, so I'm going to take that. So that one is gone. All right, so my cost of goods sold is 24, and my ending inventory is 65 minus 24 equals 41. Now, they could have just as easily come in and said, oh, I want number 12, and this one could have, oh, I want number 10, right? So you just have to keep track. And like I said, specific identification is more used for high value things, often things with serial numbers where we have to keep track of stuff, where there's actually a registration of title, like a boat, a car, trailer, or something like that. That kind of tends to be expensive. All right. So that's the basics of inventory. On the perpetual, my journal entries look like this. On the perpetual, when I buy inventory, I'll have inventory for 10, and then I will have accounts payable, usually. Remember, most business is done on credit. And so that will be my entry when I buy inventory. And then when I sell something, my journal entry will be cash or accounts receivable, either one. And let's say it's for 15. And then I'm going to have sales revenue for 15. But then I have to remember this is perpetual, so I'm keeping track of that. So now I've got to do my cost of goods sold 10, and my inventory goes down. So we're assuming in this case it's FIFO, first in, first out, 10. And so my revenue minus my expense, cost of goods sold is an expense. Revenue minus my expense is my gross profit. All right, sales minus cost of sales gives me my gross profit. So that's the perpetual method. Okay, with the periodic method, when I buy something, instead of it being inventory, yeah, I can put it into inventory, or I can put it to purchases, either one. Inventory works. 10, accounts payable, 10, that works. But then when I sell it, it'll just be cash, 15, sales revenue, 15. You'll notice that there is no immediate cost of goods sold. What happens is when it's all said and done, I go and count my inventory, and then I make my calculation as to what I have to make an adjusting entry, and that'll be my cost of goods sold will be 10, and my inventory goes down by 10. This is after a physical count. And like I said, the perpetual inventory, it's not all but gone away, but it has declined a lot over the last 20 years with the barcode scanners and the RFIDs and all those sorts of things. You know, they've got it now. I think they've abandoned it finally, but when Amazon bought Whole Foods, they put in some stores up in the Seattle area, and they just tracked the shoppers and saw what they put in the basket. They didn't even have to go through the checkout line. They just, you know, in their account, you know, they showed their membership card when they walked in, or whatever it was. They entered their data, and then they just walked out and loaded the groceries into their car. They didn't even have to do that. I think that experiment has been abandoned. But for the last year, when I go shop at Sam's now, I walk out. They don't check my receipt anymore. They just, you know, kind of look at their little scanner thing and say, "Thank you, sir. You're good." And that's it. But you know, that's how technology is improving, and you know, it's a two-edged sword. There's both good and bad, but interesting to see how it goes. All right, so the last thing I will talk about inventory is what goes into inventory. It's going to be the price you pay for the good plus any transportation to get it to you. It doesn't include your stock boys unloading it on the loading dock and preparing it and all that kind of stuff. It's only that transportation and possibly insurance for the truck to get it to you. That's part of your inventory cost, right? With that. Okay. The next thing that we talk about in the footnotes of the financial statements, how you do inventory has to be disclosed in the footnotes. And I'm just going to say this, I'm not going to get into doing the calculations or anything, but the information is that if you use LIFO, you have to provide enough information. It's called LIFO reserve. You have to provide enough information that a knowledgeable user could restate the cost of goods sold under FIFO. And that's known as LIFO reserve in the footnotes, the thing. And remember, the financial statements include the footnotes. The financial statements are not just those four sheets of paper. They include the footnotes. That being said, if you ever have insomnia problems, start reading footnotes of companies. They are exceedingly boring, but that's what financial analysts do. Right? All right. So the next thing I want to talk about is payables. So when I buy something, you saw like when I bought the inventory, I put inventory was 10 and accounts payable was 10. All right, so accounts payable is going to include all your trade credit, which is the merchandise that you purchase, or the inventory, the raw materials you purchase if you're in manufacturing, that kind of stuff. It's going to include your salaries payable. It's going to include your utilities payable, any short-term debt. Like you go to say you're in the summer boat renting business at a lake or something, and so come about the end of May, you go to your bank, you get some operating funds for the summer, and in 3 months you're going to pay them back. That would be an accounts payable, short-term note payable. All that gets wrapped up into what we call current liabilities, right? And so accounts payable, we talked about before. Sometimes they will give us a discount for paying quickly, 10 days. We'll give you a 1% or a 2% discount. That turns out to be, well, if you work it out, somewhere a little over 19% interest rate. If it's 1%, it's about 46%. If it is a 2% discount rate, that's using compound interest. And so if you get those on a percentage basis, if you get those discounts, it pays you to take advantage of those discounts. I had a friend, this was years ago when Texaco was still around and operating, hadn't been absorbed yet. And he worked for Texaco, and he was in the accounts payable department. And anything that had a discount attached to it was fast tracked, so that they always got their discounts, right? Because these interest rates are so high on that. And so yeah, that's basically all we have to talk about with accounts payable. We talked about, when we had accounts receivable, we talked about returns and allowances. It's just the reverse for accounts payable. Okay, so I get a sales discount. If it would be a allowance, that reduces my inventory on a trade account, that sort of thing. So yeah, accounts payable, very important. Manage those things well, and you've got yourself a healthy business. Now let's talk about long-term assets. And I'm going to talk here, well, I'm going to talk first about tangible assets. And of course, tangible just means something we can touch. So a machine, a piece of land, a building, a piece of equipment, a store display. These are all tangible pieces of equipment. So when we buy a piece of equipment, it will be the cost plus any cost to place in service. Okay, so let's take a dry cleaner. Almost every dry cleaner in the world, unless they're just a pickup and drop off place, but every dry cleaner that actually does the work, right? They have a boiler. They have to. That's just one of the things that's necessary to be in the dry cleaning business. And so if they buy a boiler, they're going to have it transported there. They're going to have it installed. And then they're going to have it inspected, because that's something the state requires. All boilers be inspected, and they're inspected before they're put into service, and then every couple of years after they're put in service, just like an elevator. Somebody comes around and inspects the elevator. Um, okay, so all those costs to put in service, the transportation, the installation, any dry runs where you're not actually, generating a revenue off of it, any dry runs, that would be cost of placing the service. Any inspections, any taxes that are on that specific piece of equipment would go here. All those sorts of things. Now, that being said, long-term assets we depreciate. And so a long-term asset, long-term by definition means we're going to use it more than one accounting period, or we plan to use it more than one accounting period. So we have to account for the expense. We have to recognize the expense as we use it up. Now this creates an estimate. So there are a number of ways to do depreciation. There is straight line. I'm just going to do a couple of them. There's going to be declining balance. There is going to be units of production. And I'm going to include one here, MACRs. This is a tax depreciation. And I'll talk about that in just a second. So with straight line depreciation, let's say I buy a piece of equipment for $10,000, and I expect it to cost is $10,000. I'll use this for all of them. Cost is $10,000. The salvage value is $500. The expected life is 5 years. And so now I can calculate my annual, the depreciation under straight line will be the same each year. Okay. And so what I do is I take the cost of 10,000, I subtract the salvage value. This is what I can get for scrap when I sell it, or it's not dependable. I don't want to work on it all the time, but somebody can use it because they only need it a little bit, whatever. And so that's going to give me 9,500. This is known as my depreciable value. Then I take the 9,500, divide it by the 5-year useful life. I think that's right. Oops. Yeah, so 1,900. I will get $1,900 of depreciation each year. Now, when I depreciate that, my journal entry will be depreciation expense will be 1,900 and accumulated depreciation for 1,900. Now, if I look over at my T accounts just means the ledger. I have depreciation expense, and I have accumulated depreciation. Expenses are always debits. The accumulated depreciation is called a contra asset. It lowers the value of an asset. I call them marriage assets. call them marriage assets because they go together. They're lockstep wherever they go. So this piece of equipment will always have this accumulated depreciation account. The depreciation expense is an income statement account. It resets to zero every year, and it resets to zero by saying I do it a couple of ways. The easiest way is just to debit retained earnings, 1900. Now, retained earnings is normally a credit, but by debiting retained earnings, I'm lowering them, right? So an expense lowers retained earnings. I have depreciation expense, 1900. And so now that gets reset to zero. I do not reset the accumulated depreciation. We call it a permanent account. Permanent doesn't mean like it never goes away. Permanent means it doesn't reset. In accounting terms, permanent means it doesn't reset to zero every time I make an income statement. When I get rid of the asset, when I dispose of the asset, that's when this accumulated depreciation goes away, right? Okay, so now let's say after 3 years, well, let me back up just a second. You've heard of book value. That equals the purchase price minus the accumulated depreciation. So we've got 10,000, and then after 3 years, we've got 5,700 in accumulated depreciation. My book value would be 4,300. So that's going to be the book value. All right, now, important point. So when I sell an asset, the first thing I have to do is catch up the depreciation. So if I'm halfway through the year, I'd give it $950 of depreciation expense and $1,900 accumulated depreciation. That's not the important part here for you all. What's important is how do I get gain or loss? So let's say I sell this thing for $7,000 at the end of 3 years. So I take the selling price, I said $7,000 less the book value, 4,300. This would give me a gain of 2,700. Okay, so that would be a gain. Now, don't go crazy in thinking that, woohoo, I get capital gains on that. There's provisions in the tax code to recapture that depreciation because technically you have over depreciated, right? So anyway, that's book value, and that's how we get gain. Or it could be a loss. Let's say I could only get 3,000 for it, minus 4,300. Should have done that. I would have a $1,300 loss in that case. So that's how we calculate gain or loss. So let me go through and show you declining balance. Declining balance, you can use any percentage. 100% would not be declining balance. That would be straight line. But usually it's either 150 or 200. I've never seen more. And this is accelerated depreciation. So going back to our original data, the cost is $10,000. The salvage value, here you can see it. The salvage value was 500, And so the depreciable value is 9,500. Now, with declining balance, I do not use the depreciable value at first. That just becomes the maximum amount of depreciation I can take. So what I do is I take the full cost, the $10,000. If I'm 200% declining balance, I will multiply that by 2. That gives me $20,000. I will then divide that by 5 because we have the 5-year useful life. And that will give me $4,000 depreciation expense in year 1. And then year 2, I will take the 10,000 minus the 4,000, the accumulated depreciation, which is the same as the depreciation expense in year 1. The accumulated depreciation, so that's 6,000 times 2 is 12,000, and divide that by 4. And that's going to be 3,000 depreciation expense. This number declines every year. So now I've got 7,000 in accumulated depreciation. So I've got 10,000 minus 7,000 is 3,000 times 2 is 6,000. And I divide that by 3 equals 2,000. Okay, so this is the year 3 depreciation expense. So now I've got 9,000, so 10,000 minus 9,000 is 1,000 times 2 is 2,000 divided by 3 is 666.67, except I can't go below the 95, beyond the 9,500. So this becomes 500 depreciation expense, and there is no more depreciation at that point. Okay, so that's the accelerated depreciation for that. The other one is the units of production, and this will give you various depreciation. This is good for things that may be used a lot, may be used a little. With units of production, we go back to our first. We use the 9,500, the depreciable value, and then we divide that by units. So let's say we're going to do an airplane engine. A jet engine can fly for about, let's say, 20,000 hours, 10 years. And so we get so it's going to cost us 47.5 cents per hour. Okay, so year 1, I use it 3,000 hours times 0.475 will be 1,425. In year 2, I only use it 1,000 hours. Maybe it's like a COVID year, right? 0.475 be $475. In year 3, I make up for that, and I'm going to use it 4,000 hours times 0.475. And it gets 1,900 hours. And I just go that until my depreciation is used up. That whole 9,500 is used up. Now, I'm not going to do the calculations for Macker's technically, this is a tax depreciation. It is a form of accelerated depreciation. And in most cases, it's 200% declining balance, like we showed here. There's a couple of reasons. So we use in tax what's called half-year convention. So we assume that we only use an asset for half a year the first year. So instead of it being 4,000, it would only be 2,000, right? But so you're actually going to appreciate something that is listed as 5-year property. And the IRS, oh my God, they have this book. It's about 60 pages, and it has everything in the world that you could possibly imagine list. I went through, I didn't go through it line by line or anything, but I went through, and they have abbreviated versions of this too, so that handle most things. But everything from race horses to breeding sheep to those are in there. What's the life expectancy of a boiler? What's the life expectancy of train track? You name it, it's in there. And you have to use the IRS life expectancy. And they actually calculate the tables as a percentage. So you can go look up the tables on that. But technically, it's 200% declining balance, but it switches to straight line when straight line becomes faster, right? So it is a very advanced and accelerated depreciation method. I tell you, when I'm teaching my accounting students, this is one of the hardest sections for them to get right, because there's so many little caveats in there. So what you do when you're running a business, and remember, the financial statements are not the accountant's responsibility. The financial statements are management's responsibility, with the accountants doing most of the work, right? And so what you need to do when you buy a piece of equipment or something, you're going to look at the depreciation schedule, and you will create a depreciation schedule, which does this for every year until the depreciation is used up. So each asset will have an Excel spreadsheet, or you'll have one Excel spreadsheet with all the assets listed on it. Think how big that spreadsheet is for a big company. And you'll keep that, and then you'll eliminate that when it goes. Well, of course, you have to keep the records for IRS purposes, but you're going to keep that. So it's 200%. For most things, it's 200% declining balance. If it's 15-year or longer life, then you use 150% declining balance, switching to straight line when it becomes more advantageous. So anyway, that's what we want to know about depreciation in there. And then intangible assets. Intangible assets are things like copyrights, goodwill. A copyright is obvious that if you produce a record or a book or something, it's pretty obvious that you're the only one that gets to use that commercially, make money off of it if you have the copyright on that. There is some fair use. I, as a professor, could go in there and quote a paragraph from somebody's book and be within the fair use standards. For my students, that's fine. But basically, I can't do it commercially to make money, right? Those sorts of things get involved. But for goodwill is when I buy something for more than the tangible asset's fair market value. So, and the reason I do that is because you've got an entrenched clientele that comes in there. I don't know about you, but I do most of my shopping. I'll do a lot of grocery shopping at Sam's, whatnot. But if I just need to pick up something, I'll stop at United on the way home. It's a little bit more expensive than HEB, but it is literally on the road on my way home, It's no extra cost and no extra time, or the least amount of time for me to run into United and get my thing. That's part of goodwill. Estimating goodwill from a valuation standpoint in a business before you sell it is very difficult. One of the ways we can do it, we do it for estate tax purposes. When somebody owns a business, is to look at what the expected return on the assets are and what the actual return on the assets are. And anything where the actual is greater than the expected, then we capitalize that difference and call that goodwill for estate tax purposes. That's how you estimate it when you're valuing a company. But when the only way we record it on the books is when we actually sell a company and we get a price above the fair market value of the tangible assets. Now, it used to be that we amortized goodwill over 20 years. When I was sitting in the seat as an accounting student, we amortized it over 20 years, thinking goodwill would last about a generation. And amortization is essentially the same thing as straight line depreciation. The mechanism is the same. It's just on an intangible asset. Now, however, we have to test for impairment. And so we have to, we only write it down if the goodwill is impaired. So goodwill is an impairment test. We technically have to do that for all assets. If we bought something today and somebody comes out with something that makes our $50,000 piece of equipment obsolete, well, we have to impair that. We don't depreciate it over the years. We just write it all down in one fell swoop because it is impaired. But it most notably comes up with goodwill. The rest of the assets, copyrights, trademarks, those sorts of things, we tend to amortize over the useful life, usually about 15 years on that kind of stuff. So anyway, that's what we need to know out of this chapter. Chapter 6, your test is coming up soon. I saw a handful of you as of yesterday had done all of your homework up through chapter 6. So this is a little late for you, but it looks like you had good scores, so that's good. So that ought to get you down the road. And good luck to you on the exam. And we will see you later.